You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIW Tweets.
Hello, welcome to The Investor Way with me, Sam Ball. It's the 20th of May, 2023, and I'm joined by our special guest today, Bennett, who you can find on Twitter at value_1pages. So Ben, firstly, thank you very much for coming on the show. And if you're happy to just jump straight in, could you just talk to us a bit about how you first became interested in investing and your investing career to date?
Yeah, sure. Good morning, and obviously thanks for having me and all that. So like most people, it was a fairly cliche entry. Started off kind of as my career got going in a bit of indexing, saving up for a house, learning that way through kind of Vanguard funds, and very passive, really. I think as we all were for the first couple of years, and just didn't really think about it, monthly standing, all that usual stuff. And then really just has got going over the years as your career progressed and your savings get a little healthier. Just looking a bit more into a bit of an active approach. Not too active at first. Whenever you really get first into investing, you kind of come across the obvious stuff, the kind of Buffetts, the Mungers, and you kind of look at that bits and bobs. And particularly being in the UK, stumbled across Terry Smith, Fundsmith, and that kind of whole quality buy and hold approach. And so slowly pivoted really from still being a kind of very much an indexer, but getting involved on that side of things, that kind of great companies at fair prices and whatnot. And so that happened a few years. Didn't really put much time and interest into it. Had a bit more of a passive interest with a bit of dabbling, so to speak. And then really it's only the last 3-4 years, so that's probably a timeline of about 8 or 9 years ago. And then it's only about the last kind of 2, 3, 4 years, probably coincides with before lockdown, like most of us got a bit more into it. Started reading a bit more, learning a bit more, and really started to kind of assess and look at some of the great investors, the kind of the Buffetts and the kind of the Greenblatts and the infamous Graham and Doddsville and all those, and looking at what they did earlier in their career and actually thinking that the kind of, whilst the quality stuff makes lots of sense, I was kind of maybe getting a bit greedy and thinking, well, to outperform the market and to be more of an active investor, actually, if you look at all the kind of track records of those individuals when they really first started their career, they were all kind of not really doing that stuff, not really in the quality sphere. They weren't really in the kind of buy and hold. It's obviously naturally what they all do when they've got lots of money at this point in the later points in their career. So that's where I really kind of, with identity crisis, moved away from the kind of quality stuff. It's obviously you still have an eye for quality, but really then started looking at more overlooked kind of types of investing, kind of special situations, kind of deep value micro caps. That's a bit of a cliche word, the contrarian stuff. That's where really my kind of identity crisis kind of moved me from the quality to the value stuff. And then over the last 3-4 years, just really kind of got a lot more into that. And yeah, just the general reason being, if you look at what the likes of Buffett and Greenblatt, even Peter Lynch really at the start of his career, they were all fishing in that pond of that kind of more obscure stuff, and that's where they were getting those juiced up 30, 40, 50% a year stuff. And not that I kind of think I'll ever kind of achieve that, but I just thought if I want to beat the market, as I think that's the key objective for a lot of us, that's where perhaps the biggest opportunities lie. In buy and hold on the quality stuff's great, but it's probably gonna, even if you're really good at it, it's really tough to find quality companies, in my opinion. You're probably not going to get those oversized returns or outside returns that maybe, but I'd hope you get with this kind of value approach. But that's I think you can be successful in all the different areas of investing, but that's where I've kind of that's my journey or the kind of the pivot I've made in the last few years.
So there are a couple of things I'd like to just go back to then in your answers. Firstly, what do you do for work and how old are you?
31. So I work in kind of cybersecurity. So my career was actually started in the Big Four in kind of tech consulting and cyber consulting, and I've kind of so I've been around Big Four in that environment for nearly a decade, but it's all been in the kind of tech and cyber space. So nothing to do with kind of the typical route of accounting and finance. I did an economics degree, like a lot of people do economics degree. It doesn't really touch that much on investing. But yeah, it's tech and cyber career.
So how did you end up going into that then if you did an economics degree? Did you go straight in as a graduate?
Yeah, so graduate at PwC in particular. To be honest, I went to uni the first time and kind of dropped out for a year and then went back to uni somewhere else. And I was so wanting to then make sure that I didn't just waste all that time and go back to uni, dropped out, started again. When in my final year at university, I just applied for grad schemes and absolutely everything. I think like most 21, 22-year-olds, I didn't really kind of know what I wanted to do. And so I applied for grad schemes, absolutely everything was sales roles, finance roles, marketing, kind of all sorts of bits and bobs in every place. And it just turned out that kind of vague role of tech risk was something at PwC. I'm, you can tell from the accent, I'm from the Midlands, from Birmingham, and I kind of just applied for lots of jobs in Birmingham and London. And I ended up moving to PwC, moving to London. That was kind of gone from there, really.
Are you still in London now then?
No, moved out about 4 or 5 years ago. So there's only so many years in the big smoke you get fed up with paying over £1,000 a month for rent and all the bits that come with it. But no, it was great. I did about 5 years in London. I've got nothing but great things to say about PwC, to be honest, and about the city itself. It's a great place. But no, I think I always knew I was going to gravitate back towards home, family, friends. And fortunately, I think that Birmingham is a sizable city with jobs and enough social stuff going on. So made that move back about 4 or 5 years ago.
So where did the interest in investing first come from then? What led you? I know you said you started with index funds, but how did that actually come about?
Truthfully, I think it's an element of luck, really. I think like most people in their early 20s have started to kind of build up some savings, really with the objective of getting on the property ladder, and somehow just stumbled across that kind of fact or that kind of semi-fact that's thrown around. Put money in index funds, you get 8-9% a year, which I think it's only been true for the last decade or so, but it's naive to think that's just the standard all the time. But so I think I was just chucking money in that, building up for a house. There wasn't really any much conscious thought, geared towards wanting to be getting to investing or think about investing too much. And I think that's typical of a lot of people probably have saved and helped to buy ISAs and similar kind of platforms over the last decade. And we've all been very fortunate. We've all rid a very kind of fortuitous bull market. I think it's only once I've got on the property ladder and it's just that kind of objective in life, it's just kept on indexing, and then the interest has pivoted to what the other index funds out there, what the other bits and bobs out there. I kind of pivoted, as I say, from Vanguard to the Fundsmith approach, looking at all his literature. And as I say, I met you at the Fundsmith event, so his approach and everything he says makes sense, and it did then. It still does now, and that's where it kind of pivoted from, really.
So you mentioned as well that you're quite interested in special situations now. So our last interview was with Joe Value on Twitter, who runs a special situations fund. So how did you end up meeting Joe?
Exactly. Over the last few years, I've kind of started becoming a little bit more active on Twitter. I've always been very passive on Twitter, just searching things, reading things. And perhaps I was searching or looking at certain special situations that I had no idea, but I happened to be following Joe randomly already. And he just kind of put out a bit of a call if anyone was keen in kind of putting together a bit of an investing forum. I think it's got a Discord channel, doing semi-regular meetups. So that was it, really. It was just a bit of a look. I happened to see that tweet one day and just get in touch with him. Like most kind of personal investors, it's quite an isolating kind of solo activity. For the best part of 7 or 8 years, I don't think I've talked to anyone about kind of investing in bits and bobs. And I got to a kind of point a few years ago, and I thought, actually, this is, why not kind of engage and reach out a little bit more? And that was it, really. So networked with him. Obviously, saw him again at the Fundsmith when I met you guys. Yeah.
So was Fundsmith your first one of those AGMs?
It was. Yeah.
Okay.
The one last was the one the year before. I think he caught COVID on the day, so I was in London. I was in London for the event, and I think he called it off the night before or called it off the day off. And I think the year before that was probably a COVID one, virtually. I can't recall, but yes, the first physical one was last year or this year.
So what made you decide to go to that then?
Well, I think it's the same answer. Everyone says it's somewhat cliche. It's a little bit like our UK Berkshire, isn't it? I guess. I think I've had money in the Fundsmith a few years ago. I've still got part in my pension. I'm less. I'm going to go down a rabbit hole. I'm less kind of indoctrinated and sold by the Fundsmith than I used to be. But I still think he's the premise of what he says and the fund itself. It makes reasonable sense. And I thought it was just good idea to go along, hear it and see it in person, and really just start, as I say, socialising more and getting more amongst the the community, if you will, rather than just being a bit of a saddle on my own at home all the time, just, with my head in my laptop.
Can we go down that Fundsmith rabbit hole then? Why are you not as confident on his returns going forward as you maybe were 3 or 4 years ago?
It's somewhat linked to the kind of, as I said, that pivot away that I've done myself from away from quality more to value. I think itself now, Fundsmith, is at a point of the size and companies that he's involved in and looking at, that it's very closely going to replicate the index, in my opinion, and he might beat it by 1 or 2%. I think if we project out the next 10 to 15 years, kind of companies have got very heavily weighted S&P and whatnot, but the prices are quite, I want to say high, but they're definitely kind of up there on some of them. And I just think, really, in terms of the future returns, I can't see it being massively kind of one that outpaces your indexes by more than maybe a % or 2, if at all. If you look back at the last 10, 7 years, I think he has had some tailwinds that benefited him, like with kind of multiple expansion and stuff like that. And it's kind of linked to my opinion more so as well, reflective of my opinion of the market of the next 10 years anyway. I think we'll probably talk about market valuations at some point on this chat. But I just think that the forward returns now for that kind of basket of stuff does not look that appealing to me. He does say a few things that kind of slightly irk me a little bit. There's a question this year about, is the size of the fund any kind of issue or restriction, and he kind of said no, not. He kind of batted it away like it wasn't a thing. And I think it's undeniable now that the pond that they're fishing in is such a restricted pool of companies that it's got to be mega caps that, of course, it's going to be a challenge for them. There's a few other questions and a few other things he said over the last kind of year or two that, it's just I've still got some my pension. I think it's a great kind of quality tracker. That's how I now look at it. If it underperforms the market the next decade, I don't think it'll underperform it by 1% or 2%, because I think that the premise of good companies, good return on capital, is just whether it's a little bit pricey for me, and really whether it'll differentiate from the market. I'm not too sure. But I think, generally speaking, I think it's a good fund. I'm not trying to be too pessimistic about it. I just don't think it's going to potentially give much, if any, outsized kind of returns the next decade or so.
I think that's fair enough. Give a shout out to Paul Adal, who's been on the show. He was the one who actually asked the question that got picked about the size of the funds or the investing universe. I do think as well, I agree with the multiple expansion, because, well, firstly, if it's bigger companies, it is just harder. You just need to look at Berkshire to see that. But then I do think if you actually go through what's in Fundsmith, I think it's quite good if it's stuff you wouldn't normally be able to bring yourself to invest in. But a lot of it, some of it, I do think is painfully expensive. Like there's companies in there where they're fantastic companies, but they might be like consumer goods and trading at 30 times earnings. And again, it's like you've clearly benefited from multiple expansion. And I think for quite a few of the companies in there, they have to do very well just to justify the current multiple.
To some extent, it's price for protection with some of those stocks. And again, I don't want to just start slating him, but he closed down the emerging fund recently. Was it called Feet, which is a horrendous name, to be honest. And he cited exchange rate headwinds as one of the reasons. But equally, the main fund, I think, has benefited from exchange rate benefits in terms of the dollar versus the pound. And so I think there's this. Sometimes he's very selective. He irks me as well when he talks about, if you'd have bought Estee Lauder at something like 200 PE, 101 years ago. He's very selective with kind of justifying PEs with kind of quite selective stats there. Of course, there's examples of when you could have bought companies at 150 PE 75 years ago and still beat the market. But, for every one of those, there's 10,000 that if you bought that PE, you absolutely bankrupt yourself. So it's stuff like that sometimes. At the end of the day, he's I don't say a salesman. I'm not trying to make him sound like a Dell boy, but there's stuff he says sometimes that just doesn't make me want to put all my kind of assets in him, I guess, is the summary. But still good funds. Still a kind of 20% of my pension, workplace pension. So and again, I think I'm got an eye attended next year for the event to see the content to meet up again. So
yeah, I think in fairness to him, he is very, very good at what he does, but he is also there to do a job. realistically, he's not going to sit there and say, you know what, I think it's a bit overvalued at the minute. I'd probably sell it if I was you. He's just not going to. You can't even. It's not reasonable to expect him to do that, even if he did have some of it. There must, but yeah, I'm sure he's happy with everything that's in the portfolio. That being said,
Yeah, he knows his stuff. Like he reads annual letters and stuff he says about Unilever and stock-based compensation and whatnot. He's obviously he's not, you know, he knows his stuff. But yeah, in summary, I'm just not sure if it's gonna,
so,
gonna do much more than the index in the next 10 years.
so you mentioned Berkshire, so you're all booked up for that for next year. So could you just talk to us about why you've decided to do that, and also just how you've actually the practicalities of what you've done, and whether are you going on your own or have you got anyone else that's going with you?
I'm semi-booked up, so I've sorted the hotels and whatnot. I need to plan a bit of an itinerary. Hopefully, I haven't got too many listeners from the Boyd and Nebraska area, but apart from the Omaha itself, there's not much going on around there, I don't think. So I need to think of an itinerary and perhaps pair it up with a trip to Chicago or Kansas or something. It was just knowing how popular it is. I thought as soon as they release the dates for next year, I'll get on booking.com and just kind of sort some stuff out. But yeah, I haven't put much more effort in that. I'll probably plan a trip. I've got a friend or two living in America, so I might double it up with that. But I think it's just really Warren's, is it 93 and Charlie's 99, and so Charlie will be 100 next year, and so fingers crossed. I think everyone knows that they're kind of the greatest of all time, aren't they, and whatnot. I think to get over there and be part of it, I think it's in a good way. It's it's like a big cult, but I'm fully kind of fully keen to just go over and absorb myself in it for the weekend, meet some great people, get amongst it. But to give so much of the last kind of I don't know, was it 70 odd years or maybe even more, that it'd be great to kind of see them in person, to tick that bucket list item. So yeah, fingers crossed. But 93 and 99 was But I listened to the obviously it was a few weeks ago. I listened to it this week. It's good 6.5 hours of content to get through. But they're still sharp in the mind. So it was a good one this year. Lots of good questions, and so fingers crossed. Yeah, I'm looking forward to it.
Could you talk to us a bit about your investment appraisal process and how you would approach looking at a potential new investment in terms of how you're likely to come across it, and then the process you go through before you ended up buying it usually?
Coming across them, there's no real formal process that they seem to just come out of anywhere now and again. Obviously, fair use of screeners now and again, looking at stuff, get random things just that you seem to stumble across on Twitter or the internet, large podcasts and so forth. So the source of ideas, to be honest, it's all very random, if I'm honest. The main thing for me on appraisal now, which I've kind of pivoted more towards in the last few years, is just really kind of price or value per price, which I know sounds obvious. It's really now I've moved into that kind of mindset where there's no quality too bad if the price is if there's no company too bad if the price is cheap enough, and everything's got a fair value. So for me, it's looking at the price and working out what it is and standing in regards to the business. So I kind of like to look at things on a normalised basis. So first of all, kind of relative to its history, and its peers. I think we've kind of been, that's the word I'm looking for. We've got to be careful when looking at price. I think the last bit like we talked about with Fundsmith, the price appreciation, the multiples over the last decade. We've got to be careful somewhat not to get kind of accustomed to thinking that these multiples are quite normal. But looking at the relative history of a stock, where it's trading in terms of its prices, looking at versus its peers, and then just doing some kind of absolute measures of the value of the price, in terms of kind of putting upper limits on the multiples I'd like to pay and what I think it's worth. Kind of not really a big fan of DCS. I think it's too many things to go wrong and too many numbers to come out that don't make sense and too kind of fragile. But yeah, like kind of triangulate with a combination of multiples, like looking at free cash flow yield with kind of growth and that kind of stuff. And that's it really. So price is always the starting point. The second most important thing that's sort of grown a lot over the last few years is actually thoroughly understanding the business, because if you don't really understand it and know it properly, you can buy it without kind of understand all the reasons, and it makes it very difficult then to hold it when times are tough, or to know why you want to hold it through ups and downs, when to sell it. And I think I've been guilty in the past of just buying stuff without thoroughly kind of knowing the stock too well. Over the years, you've talked about Gamma Communications on the show. It's always made me chuckle when you talk about that stock, and that I held that for a while. I even work in the IT industry and worked for two companies who use Gamma. It's still one that I've never really got my head around, and it's always good stuff, high quality, good on the numbers, on the metrics. And it was one of the stocks. And after a few years, I thought I can't hold this anymore because I don't actually understand thoroughly what it is. And there's stuff like that I've pivoted away from, trying to really understand the business. And yeah, just digging through the 10Ks or the UK equivalents, and try for as long as possible not to read kind of any blogs or articles or anything on the internet. Quickly get down into kind of confirmation bias or kind of reading stuff that just kind of oversells you or gets you too deep into it or too convinced on it. I think it's very easy to, when you put lots of hours and time into a stock, to feel like there's a bit of sunk cost and you want to always proceed. So I've tried to avoid that stuff over the years, or try and get better at that. And that's it really. Yeah, I think price is the main thing I've kind of pivoted more towards.
I will say with Gamma, I do feel quite similar on that. It is really hard to understand. So the first couple of times I properly looked at it, I did go through and sort of try and semi-work out what it's doing and try and sort of make some analogies. And then because I've not looked at what the products do for a couple of years, even now when we cover it, I'm kind of like, well, I would have to go back and like listen to myself of what I've been saying the first couple of times. So it's one where I probably just wouldn't make the position too big, but it's obviously a quality business. But yeah, what it does, I do struggle with, because it's just in my day to day, it's just something I don't come across at all. Whereas if you compare that to, for example, a Unilever or even a Facebook, they're very easy businesses to understand.
Yeah, and I think the more I've developed and learned over the last few years, and I'm not still a novice, is really just that you can't explain the business or explain the business and the thesis fairly simply, then it's probably just worth avoiding that what they call the too hard pile.
No, we're quite keen on the too hard pile.
Yeah, and that's what we'll probably come on to, kind of portfolio construction, position sizing, and all that. And so if I can't really explain the business and why I want to buy it and invest in it in half a page, then I probably should just find something I can. But yeah, Gamma was one of them. I literally worked in two organisations where we use it within my department. I still don't fully get my head around it, and so therefore it was one of those, kind of didn't get stung by it. It was a good company. I just moved on from it.
You mentioned earlier on that you find it tough finding quality, and you mentioned in your last answer that sort of one of the first things you look at is price. Do you think that's why? Do you think it's just because quality businesses are just so expensive?
Yeah, it's a large part of it. I think could get a pen and paper and write down 20 quality businesses. As you say, the kind of stuff that you typically see in Fundsmith fund. But then if you look at what I think the prices were, it's largely speaking, I think the price is always baked in. You've got to have incredible discipline to have a watch list of, say, there's 30, 40 companies, and just wait for that, metaphorical swing of the bat, I guess. And even then, you've got to have not just the discipline and patience, which is really hard to sit there on your hands for years. You've also then got to have the guts, so to speak, to swing that back, because it's often that the reason why it comes into your price range is, if you look at Meta and Facebook 18 months ago, or probably less than that, 12 months ago, that was one that fell into that region. But everyone was so scared of the metaverse and Zuckerberg going off on his whatever his vision was. And you've kind of now got that, not so much, it's definitely not fell into the value territory, but people are starting to talk about it with PayPal as well, how much that's dropped. So, and I just think it's really hard to get those calls right on the quality stuff. I think as I get older and probably more risk averse, and more about capital, kind of sustaining capital rather than growing it, I think I'll probably pivot more back to quality, if I'm honest. I think there's something nice and warm and fuzzy inside that kind of Buffett's always alluded to, partnering with good quality businesses and ones that you want to hold for the long term. So I can see myself going back to that in the future, but I think that even if you do really well, you're going to be roughly, give or take, in and around the market in terms of your performance. Or certainly, I think that's where I don't think I'd probably be able to achieve outsized returns. So I think that's it, really.
I think it's really hard with quality, though, because just to pick a couple of examples of quality businesses that we regularly cover on the show, we've looked at Coca-Cola a couple of times. I would have issues with Coca-Cola anyway, and I think it's very saturated. And as people move away from sugary drinks, you've got also that potential issue, certainly with the main product. But in terms of what they do, it's absolutely a quality business. And then you go and look at it and it's just trading at 30 times earnings. If you looked at it and said, well, actually, no, this is a business I want to own, and you had it on the watch list, if you go back and look at the price history, and this is just like one example, but we see loads like this, it's been expensive for about 10 years. And then March 2021, you got this drop, and it maybe dropped to like 13 or 14 times earnings for a month. And if you didn't pull the trigger, that was it. And we go back sometimes and we'll look at them and it's kind of like, well, imagine if you bought it then, but then you had this 1 month window. And as well, Coca-Cola wasn't the only business that was trading cheap.
Yeah.
And you didn't know it was the bottom. How much cash did you actually have like put away? Because it all came around very quickly. So it's like you might have had the chance to pull the trigger on one position, and then you can easily go through and be like, oh, why didn't I get Coca-Cola at 14 times earnings? And it's just so difficult. It's so easy when you go back and look at the graph, but with a lot of the quality businesses, your opportunity to get them at a good price is just so. I know COVID was just an absolute freak event in terms of how quickly it dropped, but you do have quite narrow windows to get them, I think, a lot of the time.
Yeah, it relies also on having the dry powder or just having a type of portfolio of cash as well. As you say, when the market falls like that, they all fall at the same time. So it's just like, well, it means probably that the ones that you're holding have fell drastically, which means you'd have to sell them at a loss to jump ship and whatnot. So it's difficult. I've read the kind of 22 bear market last year, and bear market I still think we're personally, but we'll save that. There was a lot of opportunities in about Q3, Q4 last year, and that's when I again, just as much luck as skill. That's when I jumped into Games Workshop and Domino's UK version. I think again they're two quality companies, generally speaking, but they fell into a kind of Games Workshop, like I said, is one sort of traded at high 20s, and it fell into like mid-teens for a bit, and so did Domino's, I think. Well, Domino's, I think, was even cheaper. So yeah, now and again, there's opportunities come, but it's it's far and few between, or it comes with caveats or whatnot. But yeah,
Going off on a bit of a tangent, but have you been to Warhammer World?
I haven't. I went to university in Nottingham, but never ventured to it. I've kind of always had half an eye on it.
How far is it from Birmingham?
About an hour and a quarter, give or take. Yeah, I've got one or two friends actually into Warhammer, and I've always kind of give them a nudge that if they go along, I'll join them. I think you went recently, is that right? I think so.
So I've got a couple of friends, and we've been out in Manchester and Newcastle a lot because I live in the northeast and one of my friends lives in the northwest. So a couple of years ago, we just thought we'll just start doing every UK city for like just weekends and nights out, and just rather than do the same ones over and over. So about a month or two ago, we did Sheffield and Nottingham, and in Nottingham that was a mile and a half away from. It's like a mile and a half from the centre. It's really easy to get to. So we just stopped on the way back. I did collect Warhammer when I was a kid. I probably stopped at about 13. I got like a load of it for Christmas, and then about a month later I went off it. But even then, I still like it, and it's one of my biggest positions. It's certainly one of my top 3. But just even if you go and you don't collect it, it is just really impressive. It doesn't really cost anything. So a lot of it's free, and then they've got the exhibitions, and you pay like £7 to go in. And the exhibitions are just phenomenal, like the size of them. Like if you compare it to when you go to one of the, if you go to, whenever I'm in a high street or something, I will go and have a look at the Warhammer stores usually. But when they've got like the exhibits in the windows and stuff, they are tiny compared to what's in the exhibitions. And if you're a Lord of the Rings fan, they've recreated like quite a few of like the battles and scenes from Lord of the Rings, and they're just absolutely fantastic. So it I think if you're a shareholder, it probably is worth a visit. It's not going to give you any special insight or anything, but it does just give you an appreciation for the product. It does as well. What I like about Games Workshop and Warhammer is just the client base or the customer base are just so fanatical. Like you can just, there is a certain type of man that collects Warhammer, and he is obsessive over it. Yeah. And I remember when we were paying for the exhibition, like we were in the queue, and there was a guy in front of us, and he was just buying like, 150 quid worth of stuff without thinking about it. He just sort of joked. He's like, there's 2 days salary gone. And it was just like, you could tell he was doing this pretty regularly and absolutely happy to do it. And the great thing is as well, you can't buy it from anyone else because it's all their IP. It's a bit of a rant, but it's definitely worth a trip, I think, if it's that close to you. Whereas we're like 2 or 3 hours away normally. I probably wouldn't drive 3 hours to go and do it because you can do it all in an hour and a half. But it is worth a trip.
Yeah, no, definitely. I think, yeah, still got, I went to uni in Nottingham as well. Still got friends over that way as well. So yeah, I've kind of seen the signs for it, once a year, and I was thinking, I need to do that, and then never do it. But yeah, it's definitely on the to-do list. I think, so, as you say, I saw some pictures and whatnot. It looks incredible.
Yeah, easier to tick off your bucket list than the Berkshire AGM as well.
Yeah, probably cheaper unless I go a bit nuts on a couple of Space Marines.
Yeah, which you can easily do, actually.
Yeah. Was it primary school age, or it's certainly up to backwards school age? But I was absolutely awful at painting, and I just haven't got the patience for it. And yeah, and I couldn't afford to cheat and get someone to paint them for me or whatever. But I had a few boxes as a kid, so I know it's kind of addictiveness. One of my concerns of it is actually are they pricing out kids? Because, like you said, there's loads of fanatic adults, but I think it's a bit like football in this country. You need to have kids coming through the ranks and getting into the hobby so that the next generation of buyers. And it just seems to be, the prices seem crazy, but maybe that's just me.
I think they were always crazy because I remember when I used to get it, it was like when I was up to about 13, I was probably about like 11 to 13, something. I was really into it. I remember my dad complaining because my Christmas list would just be full of Warhammer, and it'd be like a few £100, just, he called it boxes of air. But it was still extortionate. But now if you look, it's like you can get a box with 20 of the Space Marines in, and it's maybe like 20 or 30 quid. So like for not that much money, you can get a decent amount. You're not going to be able to build a proper army, but I think you can do something with it. But I don't think it's any more expensive than it was when I was a kid. I think it's just because I wasn't paying, I maybe didn't appreciate as much how expensive it was or how little I was getting for my money.
Yeah. So have you heard of the big map index where people back in flat? Someone could do a study and work out the Space Marine index and see if it versus inflation where we're at. But yeah, fair.
Fingers crossed someone's listening who actually has the time to do that, because it won't be me, but I would be very interested to see the results. But I think it's been pretty expensive for years now. I just think that when you're a bit younger, you maybe, I don't know, if I was younger and I had like a couple of £100 and that was it, I wouldn't really think about dropping it all on Warhammer. Whereas now I could drop a couple of £100 on Warhammer quite easily, and I just couldn't bring myself to do it now because I'm more aware of how expensive it is. Whereas I think as a kid, because you're willing to spend all your income on it, you maybe don't notice it as much. But anyway, that was a nice little tangent. We'll get back to the interview. What is the best book you've read on investing? And you can give more than one. And then also, how much do you read in general, and how much of that reading is investing versus other reading?
Yeah, it'd be impossible to give you a single best book. I think I kind of in prep for knowing this kind of question would pop up, but kind of thought of a couple. I think almost like a big one for me, and I think it's probably a lesser heard one that really pivoted me from that, as I said, from indexing and passive to more active, was a book by Pat Dorsey, who's kind of one of the heads or one of the founders of Morningstar, and it's the 5 Rules of Investing, which again doesn't sound like the best title in the world, and it actually doesn't. The 5 Rules part it's kind of a book that goes through all the different sections. And that was a real. I think I remember just absorbing that book in a couple of days about 4 or 5 years ago, and that really kickstarted back into active. And at the beginner to intermediate level, it's kind of a book that I'd really recommend. It really breaks down the different kind of areas of kind of valuation and thinking about stocks and businesses and portfolio management and psychology. And it's a lesser heard one than all the obvious ones like Peter Lynch and The Intelligent Investor. So I really recommend that one. And then, because of how I've pivoted in the last kind of couple of years, I think that the obvious one up there is Stock Market Genius, which I know that Joe would have definitely probably put that as his number one book. And then there's a few Warren Buffett. Have you heard of Warren Buffett Portfolio?
Yes.
Yeah, there's 2 Hagstrom books. There's the Warren Buffett Way, which is more about stock selection. But the Warren Buffett Portfolio is really digestible book as well, but it talks more about focused investing and concentrated investing. So that really kind of steered me in the last couple of years. Talks a lot about the different psychological elements of investing as well, so all the biases and stuff like that. And to answer your question about read a hell of a lot of investing books, there probably comes a point when you've read about 30 or 40 where you start saturating all the key parts. So yeah, kind of keen trying to pivot to more books about psychology and stuff like that. But there's so much material out there; it's hard to get through it. But the Manual of Ideas is another great book. That's probably breaks it down into about 10 different investment styles. And again, it kind of hones in on the styles of investing that have just empirically shown to outperform in the past. So there's a whole section on kind of micro cap investing. There's a whole section on kind of nets or liquidation. There's a whole section on, you know, various special situations and whatnot. I think it talks through the kind of more quality focused and stuff. So that's a kind of good one as well that kind of I enjoyed over the last few years. And then really to ruffle a little bit more, I've started just pivoting more to books about investors as such, and more biographical or autobiography kind of style. I don't know if have you read any of the Buffett books? So you got the obviously American Capitalist and Snowball.
Yeah.
In particular, I think Snowball, if you read like the 50s to the 70s, like what was Buffett really up to when he kind of had, you know, just less than a couple of million or before his assets were kind of really big, that kind of stuff he got involved in. That's it really. I think you got the two Peter Lynch books are fantastic. I think One Up on Wall Street gets the main praise and main credit. That's the kind of book that tells you how to assess companies, assess stocks, think portfolio. But in line with what I was just saying about kind of biography style, Beating the Street's really good as well, because that goes through what did he do when he got his hands on the fund, how did he start off in the first few years, what kind of companies. I think once you've done probably the key staple of that 5-10 investing books that talk about PE ratios and all that kind of stuff, I've really started benefiting more from learning about actual investors, what they did, the actual companies, the actual work they did, and that's really been useful over the last kind of year or two as I've moved more towards those books. I've tried to kind of put time aside every day to read. Obviously, life gets in the way, so I like to try and get half an hour a day and really try and, as you know, benefits of working from home these days, kind of use that commute time, get up a bit early and put an hour or two in maybe before work, bits and bobs. Yeah, not reading that much outside investing a great deal. I've come across the occasional blogs, and I've read some of the kind of psychology type books, you know, the Kahneman type stuff, and there's a few bits. I think a lot of that material I try and absorb through podcasts as well. Not e-books, not audio books as such, but just kind of podcasts on the topics that kind of in and around investing. So yeah, so definitely try and get a few hours in a week. It's just when I can.
I do find it interesting how when I ask this question, generally most of the people who come on are readers, but you do seem to have a split. You've got ones that just read investing books. So, for example, Joe was exactly the same. I don't think he really reads anything outside investing. And the pace at which he reads it as well, I don't understand how he hasn't run out of books. I know there's loads of them. He's just reading investing books and he's churning through one every few days. But then you've got some where they just read everything and investing's part of it. But I do enjoy investing books, but like you say, I think once you've read a few, they do, some of them get a bit repetitive in parts. So I can't read one after another. I find that I can only sort of 1 in 3, 1 in 4 of my books might be investing or related to it. But otherwise, I know it's good to go over the same content, but I do just get bored otherwise. I do need other stuff.
Yeah. No, I've got to that point now where I've got on my bookshelf about 8 or 9 left that I want to get through, and they are more the biographical type ones. And then, yeah, I think I've kind of probably saturated it. I think it's good to repetition obviously makes you learn, but it's time to pivot and move away from other stuff. And if you listen to kind of Charlie Munger and all the voice chaps like that, you can learn just as much from books outside of investing. There's that whole mental models approach. So yeah, conscious of that, and yeah, I think once we've got through these handful or so, yeah, definitely want to kind of take it a bit easier. I think.
One thing that I found really interesting was it was a bit of a lockdown project, but because I've done a lot of the sort of like people's top 20s investing books or whatever, just switching, it's that Charlie Munger style, just switching towards like I did, the Gilded Age, and so when you had like the Rockefellers and the Carnegies, just like reading about them and like the Vanderbilts and stuff, and that I found really interesting, especially as well because a lot of it it's not like really that much investing lessons you can get today, but it's really interesting because like a lot of them, because they had so much money, they were investing, and just the way the stock market used to work and all the insider trading and stuff, it is just so interesting. But you're not going to learn loads about investing. It's just quite interesting.
No, I'm not making note of that. I've not looked too much into that stuff. A couple of years ago, I went onto Amazon, so I went to Google like the top 10 autobiographies of all time. And I think I thought, I'm going to work my way through these, and end up didn't, obviously. But one of the ones I got was called the Power Broker. I don't know if you've ever heard of that. It's kind of up
No.
there as one of the best biographies ever written. It's like one of the founders of kind of New York or modern New York, and it's honestly it's huge. You kill a horse with it. It's I look at it and I just I can't tackle that. It's it's bigger than security analysis. It's that big. But there's books like that I need to start tackling over the next few years. As you say, it's time to pivot away from just reading about P ratios and whatnot.
So there's a very good one. So it's called, so it's a Vanderbilt one. It's about Cornelius Vanderbilt, and it's called The First Tycoon. But that's just, so he was basically the first man to become like a tycoon, because prior to when he did it, you couldn't really do it because like corporations and stuff didn't exist. So because it was unlimited liability, people could only get so big before people started suing them and stuff. And they basically everything that they owned, they had to be able to directly control, because otherwise they'd just be bankrupted by it if something went wrong. So Vanderbilt was the very first tycoon, and that's really interesting because he built up all this money that no one had basically built up before. None of the regulations or anything to deal with these people existed, and he was almost like a law unto himself. Like some of the stuff he did was just outrageous. Like I mean, there's one point where he was trying to. This was before the Panama Canal existed, and he was trying to build a canal through Nicaragua. I'm not very good at pronouncing it, but the Central American country. And basically there was some guy that came in and just overthrew the government and then stole all his steamboats off him and stuff, and his project was ruined. So you obviously wouldn't be able to do this now, but his solution was to organize a coup and overthrow basically the dictator of this country so that he could get his stuff back and carry on with his canal. Whereas now you wouldn't get away with that sort of stuff. So it's really, and again, just some of the stuff he was doing on the stock market, because insider trading was just, there were no laws against it. And if anything, it was actually viewed of as almost like stupid to invest without insider knowledge, because the people who had the money to invest also had the contacts and knew people. And then equally, there was just the way the valuations were. It's really interesting because there was no concept of like a PE or anything. It was just judged on like what the company could get out. So you might basically be buying a company with no PE, and you'd be getting like a 25-30% dividend yield, because they pay it out every year and no one was really valuing it with more than like a few years profits. So what these tycoons would do is they could just compound at such a phenomenal rate that you just wouldn't be able to do now. But that's a very good one.
What's that called?
It's called Vanderbilt, the First Tycoon. If you Google it, it should come up. But he was just an absolutely fascinating guy. And he did what's quite good with Vanderbilt as well is like he's best known for the railroads as a railroad tycoon, but he actually made his money in steamships. So he was a true entrepreneur in that, like, he was always just sort of switching and pivoting. And, when he could see which way the times were moving, that was when he ended up getting into railroads. And then there's ones like the Rockefeller one by Chernow, the big Rockefeller book. That's also very good. But again, that's an absolutely mammoth book. It will take a while to get through that. But again, really, really interesting. And that was the guy who set up Standard Oil. But yeah, it is worth going down that rabbit hole. If you're interested in investing, I'd be surprised if you didn't find it really interesting.
I'll make a note of those. There's a whole list of like Charlie Munger recommended books to that flavour.
Yeah, that's where I've got a lot of mine from. So I used to, if you go through like the 90s Berkshire meetings, they don't do it now. But Charlie used to get the same question every year. What have you been reading? And he would recommend a few books. So I just made a list of all them, and I've been working through them. And there's some really, really good books on there. I've not done a Ben Franklin one yet.
He loves Ben Franklin, yeah.
So what are the best resources you use for investing? And these can be free or paid.
So I don't know if it's the frugal value investor mindset, but I've still managed to get by without paying for anything really. So I've still kind of got by with the kind of the free stuff. Obviously, good old use of Excel and all that kind of stuff is the obvious stuff. I've started to try and pivot to be better at journaling and recording stuff. So I've started using Notion recently. So the jury's still out on that. I need to get into it, but that's something that's kind of moving me away from the typical Word documents and Excel. In terms of stock analysis, I think the main thing I say I'd spend 80% of my time on is actually TradingView, which some people sort of gasp and think it is a platform probably primarily towards traders and charters and all that. But if you look past that stuff, the actual data on there, the screeners, the filters, and the way it lays out all the kind of financial statements and stuff, I found that to be probably the most powerful one to use on its own. Kind of the various tools are in there. You get eight years of data, which is fair enough to do most of your analysis. Also, you kind of use QuickFS and Morningstar, the two other ones. So I kind of triangulate between those three. There's bits of ratios and data, and obviously, if anything looks kind of good and worth digging into, go direct to source. So those are the main three. I think big fan of looking at kind of insider activity. So you've got Open Insider for the US kind of markets. Use AJ Bell do a direct to dealing service. That's free. You can dig through to see buying in the UK. Haven't found as much for Europe. To be honest, I don't look at Europeans much, but probably short time and effort and whatnot. So that's the bulk of probably 80-90%. I guess it depends how far you extend the term resources. I'm a big fan of podcasts and even YouTube, to be fair. You can just sift through all the kind of clickbait stuff. Podcast wise, huge fan of Acquirers Multiple. I think you've mentioned Toby Carlisle before, so that's the kind of big fan of. Had a bit of a man crush on Tobias, and that podcast is really good. They kind of chew the fat each week of the kind of current affairs and whatnot. And again, probably a bit of in my own echo chamber, but kind of align with their views on the markets and whatnot. So it's kind of a show that I enjoy. And a really good one as well, podcast-wise, I recommend is Focus Compounding. If you've heard of that one, it's Jeff Gannon. He's got a humongous brain. He's one of those who's been doing investing since he's about 11 years old, and kind of they've done about 300-400 shows now. And it's a bit like Acquirers Multiple now. Each week they just talk about the current market and what's going on, which is good and really useful. Try not to get too sucked into too much noise and too much bits and bobs, but it's useful to know what's going on. But it really pivotal learning for me over the last couple of years was going through the Focus Compounding back catalogue. So I think there are about 400 episodes now. For the last 200 or so episodes, they've gone through current affairs, week by week, etc. But the first 200 episodes, they kind of just go through general investing topics like valuation, and portfolio management, whatever it is, notes or whatever it is, and you can, Jeff is incredibly astute and smart in investing. So have you heard of Focus Compound? Have you heard of the podcast or that?
I haven't. No.
Honestly, I can't recommend it highly enough. It's one of those. Even if you've been doing this, I think we're all to some degree beginners and intermediates until you get to Warren and Charlie's age. We're all kind of beginners compared to them. But even if you've been listening and reading and doing investing for years, honestly, that whole back catalogue is great to go through and just to reiterate, relearn, or go through stuff. And it really helped me a lot, particularly in things like valuation and looking at businesses. So I can really recommend that stuff.
It might already be on your list, but if you're a fan of the Acquirers Multiple, they do a meetup every year at the Berkshire meeting. So you might want to pop that on the list if it's not already on. But
I follow a few of them on Twitter, and I've seen that pop up a few weeks ago. Just turn up and smile and wave and hope someone talks to me. But I think when it comes close to the time, I'll try and see if there's any kind of the UK people heading out and try not just be that guy in the corner stood on his own with a coffee. But it's a good shout to look at that.
I don't think you'd have any issue because I've only done the Fundsmith one, but I know we sort of we already had a group that were coming beforehand, but I do find it's although it's quite funny investing because it is a lonely hobby, but then when you do find people that these events where people are interested, because it's lonely for everyone, people are very friendly and it is easy to talk to them. And I think in America, I do think the Americans are quite friendly anyway. So I think if you go over there and you go into the events, and so I think people will just talk to you. I don't think you'll have to do anything.
No, definitely. You just I'll shoot myself into a circle and just look for eye contact and go from there.
Who do you look up to as an investor? And I know you've already touched on a few names.
I think it's in terms of the phrasing of looking up to. Actually, I think the two people look up to are probably Charlie Munger and Guy Spear, and not so much from a actual just pure investing perspective, like in terms of their investing approach and what they do. More so, really, I think that they're just kind of people of integrity and good people. I think money management, wealth management, investing and stuff, there's a, not to say all the other names I mentioned, like Buffett and whatnot, not great people, of course they are, but those two in particular have kind of really kind of embodied and educated in terms of that kind of passion for self-improvement, for thinking mental models, for acting with integrity. And I think that kind of stuff's really important as well. Like, learn and get into investing, but they're kind of more like role models in that sense of the word, rather than just, the pure investing sense of the word. Don't get me wrong, I think if you hung around with Charlie, I think he'd be treading on eggshells. I don't think he suffers falls. So he probably wouldn't want to hang around with me for too long. But yeah, I just think that the people have, just good people with good standards, and that's kind of useful to kind of look up to in some respect.
I think one thing with Charlie in particular is if you compare him to Buffett, they're both fantastic investors. I know Charlie's nowhere near as wealthy as Buffett, although he's still a billionaire. But yeah. I'd much rather have lived Charlie Munger's life than Warren Buffett's. I think he sacrificed a lot to get to where he's got to. I know Charlie's obviously had to make sacrifices too, but I think Charlie's, in his younger years, was more aware on the sacrifices he would have had to have made to get to Buffett's level of wealth. Whereas I think if Buffett were to go back, I don't know if he'd end up being as rich as he is now, because I think some of those sacrifices and like time spent with family and stuff, I don't think he would do it again.
Yeah, that's a good point. I've always been keen to know what would have happened to Peter Lynch if he carried on, because Peter Lynch's record was amazing, but he just bloke. If you look at his timeline, he only did about 12, 13 years, because he was working 7 days a week. It was in a different city every day, and the cost and the toll it took on his family and his personal life. That's why he just basically for 12 years, quit 13 years, whatever. So he was kind of like Buffett, but then decided that had a wake-up call, I guess. I've never met a bloke and spoke to him. I'm being a bit presumptuous, but you get the point. I don't know. Maybe when we've got a couple billion each, we'll have that problem. We'll see where we get to.
Yeah, I think Lynch is good as well, though, because he's obviously, it would have been nice if he's carried on, but he retired at like 50. Yeah. And again, in terms of quality of life, it's like, say you've made 10 million, compare that to like just spending every day and night for another 20 years and not seeing your family, and then maybe getting to 100, 200 million. What is the difference in your quality of life? Because once you get to those levels, you just don't need to be doing it. And I think, again, with Lynch, I think in terms of his quality of life, it would have been nice for us if he'd carried on, but he probably did the right thing. I think it's interesting with Lynch as well, because he had such a short time frame. You do sort of wonder, is he that sort of one manager where it's, if he'd gone on 5 or 10 years, would he have mean reverted? And as well, one thing I like with Lynch is just his style's quite, in terms of the number of stocks he actually had, there's not really, I can't think of any other examples of investors that have had like stocks with portfolios with 1,400 stocks in and smashed the market like he has.
Yeah, no, definitely. Yeah. No, I think having read the Beat in the Street book, I think there was definitely strong methods to it. He seemed to beat the market when it down, he was up, and he seemed to really know what he was doing. But as you say, it's hard to know. It would be incredible to know if he'd carried on for 20, 25, 30 years, but he bowed out at the top. Can't blame him for that. I think we'd all love to do that, I think.
So you've mentioned that you're starting to get more involved on Twitter. Which accounts would you recommend following the most?
I don't really have any to recommend. I think my main approach really using Twitter is just kind of searching the topics and the tickers, and then just suddenly I might just randomly follow a handful of names or chuck my hat into a conversation. So I haven't really got any kind of Twitter accounts as such. There's a couple of YouTube accounts. I've mentioned some podcasts. I'm a big fan of kind of Pension Craft and Plain Bagel on YouTube. I try and put time aside to look at their content. But no, I think Twitter itself, it's amazing, but it's also, it's I don't know if you've seen that Ricky Gervais sketch about it being kind of the town square where you just get all sorts of people shouting all sorts of things. So I've kind of got more active in the last kind of year or so, or a few months, just because I think investing can be a lonely hobby, but you also then end up getting caught up in a lot of people that you don't want to be caught up with. So it's kind of balancing act, really, trying to find a healthy sense of use of Twitter without getting too absorbed by it and the people that are in that world. Yeah, no, sorry, I don't have any specific recommendations. Just search topics, search tickers, and use it that way, really.
What do you know now that you wish you'd known when you started in investing? And also, how have you evolved as an investor?
I think the main thing that kind of evolved and avoided, I think we're roughly the same age, give or take. I think we've been quite fortunate to be able to make a lot of mistakes over the last decade and not get stung too much because we've been living in a very fortuitous bull market. So you could buy all the popular stocks, generally speaking. You can buy high PE, hot tips, all the stuff off Reddit, and probably do okay. Also, there's lots of cases where people have bought stuff and post-COVID and absolutely battered on the way down in the last 18 months. But there's lots of kind of learning to be able to make without touch wood being stung too bad. But it's that stuff really. It's just moving away. What I've learned is just avoid anything popular really. Avoid anything that anything on the internet or anything on things places like Reddit. Just really take it with a pinch of salt. And in general, just copying. I think we're all guilty in the early part of career is kind of whether it's copying super investors or copying things that sound smart and clever on the internet. There's so many ways to be convinced by a bad thesis, but I've just tried to move away from that. But again, they're all mistakes that were worth it. And then really, from the involvement perspective, it's just kind of what I mentioned before, kind of pivoted from the quality more to the value and the special situation type stuff. More so, but there's a lot of special situations and probably stuff that Joe does. It's just a bit complex for me. I'm not that smart, but try and look at stuff that's very simple that you can explain on a page. So I'm a big fan of spin-offs or liquidations, but nothing that's too complex that requires too much brain power. And then the other part of evolution is the mental side. So being aware of all the kind of biases, the kind of all that hindsight bias, kind of getting caught up in groupthink, and just all the kind of things that we tend to think we're better than we are, or we tend to just, once we think we've got a great thesis, get sucked in by confirmation bias. So it's just trying to stay objective, be patient as well. I've done a lot of rushing into positions over the years. So I think that's it. The other one was mentioned. I want to talk about gamma and just understanding the business. Just keep it simple, understand the business. Yeah, I think those are the main things.
So I think this brings us then towards the end of the questions that are more about your general philosophy. So I'll wrap up part one now, and then we can do your portfolio as a separate interview, as a separate episode. Before we finish, where can people go to find out more about you?
To be honest, I don't actually even know my own Twitter name. I think you called it at the top of the show.
It's @value_1 pages.
Yeah, so as I mentioned, I've just been in isolation and silent in the public domain for the last however many years. So it's only the last year or so, or the last 6 months maybe, that I've pivoted to be more active. So to an extent, I don't have many followers, I don't really put much content. I'll start to get a bit more involved on Twitter and whatnot, but at the moment it's still low key. But yeah, that's it.
Right, well, in that case, thank you very much for coming on the show, and thank you everyone for listening, and we'll see you all next week.
Super. Thanks, mate.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter @TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.